A lot of tax problems do not start with an IRS letter. They start months earlier, years earlier, with bad records, wrong withholdings, untracked income, or just life. Life gets messy. There are illnesses, deaths, divorce, job changes. And if life gets messy, taxes get messy too. So today I'm giving you 6 things to check on now so that you don't get a messy surprise later. I'm Deltrease Hart Anderson, keeping the IRS out of your pocketbooks, wallets, and bank accounts. Thank you for joining me for another episode of Tax Problem Solved, where I'm going to give you a mid-year tax checkup so that you can avoid tax troubles before they start. So I'm going to walk you through 6 areas to check now while you still have time to prevent a tax problem instead of paying someone like me to help you clean up one later. I promise you it is most expensive when you have to clean up a tax problem, when you have to resolve back tax issues versus getting the issues all dolled up and being proactive, if you will. So the first one I'm going to talk about is stop treating your tax records like an emergency project. And I want to preface this by saying I know life gets in the way, but one of the first things I see when someone comes to me with a tax problem is typically unorganized records, okay? They have bank statements scattered across several accounts. They have receipts in the glove compartment, in a shoebox, sometimes in a Kool-Aid pitcher. I am not kidding, I swear. I had a client to bring me their receipts in a pitcher, a Kool-Aid pitcher, okay? So, no joke. Now, they have documents, but some documents may be in email, text messages, and sometimes no place at all. Then I will hear, I know I had more deductions than this, and they are probably right. I believe them. But the IRS does not give deductions based on what you remember spending. You actually need the receipts. Good record keeping is not just about making tax prep easier. It can protect you when the IRS questions a deduction, when your tax preparer needs information quickly, or when you need to prove what happened on a return from years ago. And for my fellow real estate investors, my fellow business owners, when you're wanting that new loan, when you're wanting to refinance, when you're wanting an SBA loan, real estate investors, when you want that next property, those financial statements come in handy if you have them quick, right? So here is what I want you to work on this week, okay? Because we're in a mid-year season. We have it. This is our fresh start, if you will. I want you to create one tax folder for 2026. It could be electronic, it could be paper, it could be both, okay? But label it clearly. Then start adding documents as they come in. If you have charity, put your charitable contributions in that folder. Put your medical receipts in there. Put your records for your business expenses, your rental property expenses. Separate them. Even if you have multiple properties, separate those expenses, those receipts by property. Put your vehicle expenses in there. Education, retirement, any documents you have involving a sale or a purchase of property, put it all in there. If you're self-employed, you own rental property, or you have a side hustle, do not wait until January to figure out your income and expenses. You should know what is happening every month. And let me tell you, I have been in situations where I myself had to figure out things quickly. It's not pretty. It is, oh my gosh, it gets on my nerves. It is a daunting task because here is the tax problem spin. Poor records can lead to missed deductions, overstating your income, an incorrect tax return, and sometimes an IRS audit that you are not prepared to defend. So, simple solution. I say simple, but I want to be realistic. The solution is to start building the habit now. One folder, one system, add things as they happen. I promise you, you'll thank me later. So, number two, we're going to talk about making sure your filing status fits your real tax life, okay? Your filing status affects your tax rates, your tax deductions, your credits, and the way your income moves. What I mean by that, the way your income is actually taxed. And it is not something you should automatically copy from last year's tax return. Did you get married? Did you get divorced? Are you separated? Did you have a child? Did you lose a spouse? Are you starting to support parents, grandparents, nieces, nephews, other family members? What are you doing? What's going on? How are you moving in your tax life? Because those tax life changes may affect whether you file single, married filing joint, married filing separate, head of household, qualifying surviving spouse, like all the things, right? And let me say this clearly. Filing status is not something that you want to guess at because your cousin said that is what they did, or the person you heard in the barbershop or the beauty salon said, oh, that's how I file. No, I've seen people claim head of household when they did not qualify for head of household. I've seen unmarried parents both try to claim the same child. I've seen divorced parents make an assumption about who's going to claim with the children without checking with what the divorce agreement said, without checking with what the tax rules said. That can create delayed refunds, IRS notices, audits. You may have to amend the return, more money, because y'all don't like to pay for tax prep, penalties, and fights, arguments between family members who were already not getting along. I've seen it. I've seen it all. I've been in the game for a long time. The solution to this is to review your filing status. Check in with yourself. Check in now. This is mid-year, especially if your family situation changed. Don't wait until your tax preparer asks you questions in February, March, April, and you're trying to reconstruct your tax life from the prior year. Don't do it. Number three, you got to understand adjusted gross income. Know what that is before you get a tax surprise. A lot of people hear that term adjusted gross income or AGI and tune out. But your AGI is all the rage in this tax game. Your AGI matters. It is generally your total income from all sources minus certain allowable adjustments. And your AGI can affect your tax rate, your eligibility for certain credits and deductions, healthcare related stuff, retirement contributions, and most of the times your tax planner or your strategist, they're going to start looking at your AGI first, okay, to see what they can do to reduce your tax bill, okay? But you have my friends, you'll forget about that rental income, your side hustle. Somebody forgot about that crypto transaction, stock sales, interest, dividends, all the things. Somebody was unemployed, they drew unemployment for a hot second, debt cancellations, or some other reported 1099 income. It could be 1099 NEC, MISC, 1099K, all of the things, okay? And people get shocked. You get shocked when your returns look different. When you see, oh my gosh, I owe money. The problem is not always that you made too much money, because that's the first thing people go to. Oh, I must have made too much money. No, the problem is that you did not plan for your tax impact of the money that you made. That's why a mid-year check-in is all the tax rage, okay? Look at not just your W-2, look at every income source that you have. Now you can ask, are there legal, documented tax planning strategies that may help lower your tax bill? Okay. or lower your taxable income, lower your AGI. That could include retirement planning, business deductions, any proper entity and payroll planning, rental property planning, timing income and expenses, making sure you are capturing all the deductions that you're entitled to. Sometimes when people sit down with me and say, "Oh, I want a tax plan," before I even do that, I like to either ask them what they know or educate them on, have you deducted all of the basic things that you were entitled to before you start this tax planning journey? Okay? Tax planning, it is not magic. It is not social media nonsense. It is understanding the rules early enough to make smart decisions before December 31st so you won't get a tax surprise next year. Number 4, check your withholding before the IRS checks your bank account. This might be the biggest one. You have to pay taxes as you earn income. For employees and many retirees, this typically happens automatically through withholdings. But withholdings is not set it and forget it, because one place, your retirement doesn't know how much you get from Social Security. So your retirement check doesn't know how much you make with Social Security. You might have a part-time job. They don't know that you get retirement and or Social Security. And even if they know, they don't know how much it is. They don't know how it's going to affect you come April 15th. So if your income changed, they don't know whether you're married. They might know, but there again, they don't know your tax DNA. If your income changed, your spouse started working, you picked up a side hustle, second job, you had a child, you now claiming a grandbaby or a niece or nephew, you started receiving retirement income, you bought a property, sold a property. It's so many things, okay? Your withholding may no longer be enough, that automatic withholding that you're getting from your retirement or Social Security. On the other hand, too little withholding can create a balance due, and in some cases, an underpayment penalty. Yes, the IRS will penalize you for under withholding, okay? IRS has this tax estimator, and that tax estimator has been updated to reflect changes involving deductions and credits, interest, overtime, all the things. So you may want to look at the IRS withholding estimator on irs.gov. But please hear me. Just because a deduction exists does not mean you automatically qualify for it. And just because you heard about it in these social media streets does not mean that it applies to your tax life, to your tax situation. Okay? So the solution is to do a paycheck checkup, a whatever income source you have, because everyone doesn't have a pay stub, but you want to do an income source checkup. Review what you are withholding. If you are, use the IRS estimator as a starting point. Then submit a new W-4 to your employer. But if you're self-employed, a real estate investor, a gig worker, withholding may not solve your problem. You may need to make estimated tax payments. So don't wait until tax season to discover that nobody has been paying your tax bill all year. Number 5, update your name and address before the IRS mail gets lost. You would be surprised how many people miss important IRS correspondence because the IRS don't know where you stay. Now the notice has expired, the deadline has passed, a collection notice gets unanswered. Now, even though the IRS don't know where you stay, I bet they know your bank account information. Okay? So if you move, update your address with the IRS, okay? Because that's a very expensive way to find out that you didn't update your address. If when the IRS starts taking money from your bank account and you're like, well, I didn't get a letter, and the IRS is like, oh yeah, I sent that letter. Okay. So update your information. Do not assume, even if you got mail forwarded, don't assume that that mail forwarding system will protect you forever. And lastly, drum roll, use your retirement savings as a part of your tax strategy, not just for the future. So, retirement planning is not only what happens when you stop working, it could be a part of your tax strategy now. And for my real estate investors, you probably already know where I'm going with this, but certain retirement plans contributions can reduce your taxable income depending on the plan and your eligibility. And then for some, contributing to a workplace retirement plan or a traditional IRA can help you lower that AGI. And if it lowers the AGI, it's going to reduce your current year taxes. But do not make the retirement contributions blindly just because someone said, oh, you need a write-off. You really need to understand the limits. You need to understand deadlines, whether the contribution is deductible or not, how it fits into your tax life and your cash flow, and what does it mean for your larger financial plan. Are you wanting to invest in real estate through your retirement? That's what a lot of real estate investors are doing at this time. But the last thing I want is for you to put money somewhere that you can't access easily just to save a few dollars. And now you're ignoring your tax debt, your emergency savings, your business needs, business owners, or any other priorities or obligations. So the solution is just to look at your retirement contribution, look at your retirement account as a piece of a complete tax plan. That is all that I have for you guys today. Just know mid-year is the best time to get organized. You still have time to create a plan for all of those things that I talked about, okay? It starts by creating a system, a tax life system, a tax record system. If you need any help or if you have any questions on anything that I went over, I know it's like drinking from a fire hose, but if you have any questions, please feel free to reach out to me at www.callthetaxpro.com. That's www.callthetaxpro.com. Thank you guys so much for listening to another episode of Tax Problem Solved. I'm Deltrease Hart Anderson, keeping the IRS out of your pocketbooks, wallets, and bank accounts. Till next time, bye y'all.